If you've been watching the housing market closely, January can feel confusing. Inventory numbers often rise at the start of the year, and it's easy to assume that something meaningful has changed. People begin to wonder whether buyer demand has cooled, whether homes are starting to sit longer, or whether the market is shifting direction. In most years, what's happening is far more structural than emotional, and far less dramatic than the headlines suggest. To understand why January looks the way it does, it helps to understand how inventory is measured. Inventory is typically reported as months of supply, which is calculated by dividing the number of homes currently for sale by the number of homes that closed in the most recent 30-day period. That distinction matters, especially in January, and here's why. December is consistently the slowest month of the year for pending sales. Those lower December pendings then become the January closed sales. When January reporting begins, inventory calculations are therefore anchored to a period of reduced closed sales that reflects December's slower pending activity, not current buyer demand. At the same time, new listings begin returning to the market after the holidays. Sellers who waited through December start listing again, and that listing activity shows up immediately in the data. That brief overlap, listings increasing while the denominator of closed sales is temporarily low, typically causes inventory to rise in January. This is not a sudden loss of demand. It's not a market reversal. It's a measurement effect created by how timing and reporting intersect at the start of the year. When you look at long-term local data for Southwest Washington, this pattern has shown up repeatedly. In most years over the past decade, inventory increases from December to January, then stabilizes and even moves back down as buyer activity and closings pick up in February and March. There have been exceptions. In early 2022, rapidly rising interest rates disrupted buyer demand in a way that broke that historical pattern. Outside of moments like that, though, the January inventory bump has generally been short-lived and consistent. This also connects directly to what we discussed in last week's December market recap. While many year-over-year indicators showed strong repeatability, pending sales were down more than usual. If a slowdown in pendings were to persist beyond a single month, it could extend what is normally a brief January increase. January inventory numbers are best understood as context, not a signal to rush forward or pull back. They reflect a seasonal reporting lag more than a shift in market fundamentals. Clarity comes from watching how inventory, buyer activity, and pricing behave together over time rather than reacting to a single data point. Full details are in this week's Market Pulse Weekly blog. You'll find a link in the description below. See you next week.